his words were, "You're not venture backable." Right. And so I didn't know what that meant. So for me, I was like, "I'll show you. What do you mean I'm not venture backable?" And I just thought that meant, like it's not, big enough, or he didn't believe in me. But again, I didn't understand the rules of venture. So one of my favorite things to do with an entrepreneur as they're asking for an investment is I go, comments like that. Do you actually understand, the venture fund? Do you understand the angel investor? Do you understand? And it's usually, no, I just am asking for an investment from Mike.
Today, our guest is a founder, investor, venture builder, and one of Orange County's most respected voices in a startup ecosystem. He is the founder of Ardius, a company that helped business recover valuable tax credits and was successfully acquired by Gusto. Since then, he has become a prolific investor, advisor, and venture builder, helping founders navigate the journey from startup to a successful exit. His work has earned recognition as Octane OC's Best Tech CEO, LA Times OC Visionary, UCLA Bruins Business 100, and LA Business Journal's Leaders of Influence Award. Today, he serves across multiple venture funds and startup organizations supporting the next generation of entrepreneurs and innovators. He has spent years studying what separates companies that scale from those that stall, and why some founders create lasting value while others never reach the finish line. In this episode, we're going to talk about building and selling companies, venture capital, startup mistakes, and the founder's psychology. And one of his favorite topics is how great founders should think about their exit long before that they ever plan to sell. So let's go ahead and welcome Joshua Lee. So before we get started, I always want to ask this question. If your life was a movie, how would you title it?
Ooh. Well, we'll probably get into this a little further, but sometimes I feel it's Groundhog's Day. Number one, it's just love the humor in that. But sometimes I feel like as an entrepreneur, and we'll get into this probably later on in the podcast, it's almost like every day we wake up, right? There's challenges, imperfect data, imperfect information. We make decisions that to outsiders seem crazy, only to go back to bed and wake up and do it all over again. And so that's, probably the title of my movie, Groundhog's Day.
Before we were rolling, we were talking about this whole idea of my first overnight success.
Yes.
Where like entrepreneurs or founders, they think it's hot, they think it's cool and sexy, but it doesn't really work that way. And you said it very beautifully. How did you say it again?
Yeah, I think we imagine, this one iconic moment, right? Where it's like the movie Rocky, right? It's like us, Adrian, and then there's a knockout, and we see that last 10%, right? Where we got the exit, or there's an IPO of some sort, and we just over glorify it. Where I think it's more like the movie Groundhog's Day, where we're just repeating this over and over and over, and sometimes it's insanity. It really is insanity.
The thing is, Josh, unless they have a clear vision of what that last 10%, the exit, the win, the Rocky standing, on the top of the steps, they can't get there. So you need both. You need to be able to grind, as you said, but you also have to have the vision to get you through to the next day, right?
Speaking of pop culture, maybe this is an old movie, but there's this movie called Chariots of Fire.
Yeah.
You guys remember that?
Oh my gosh.
I'm dating myself here probably for everyone.
That was a long time ago. Yeah.
But in the movie, the main character, Eric Little, he goes, when I run, I feel God's pleasure. And so there's also this aspect, I think, I'm calling Big Mike here, that Mike touched upon. We're talking about like it's running a marathon, right? And we get to see that last moment, that last, crossing the finish line, if it works out even, right? Whereas, hey, there's a 99% of the race we didn't get to see, and we're like right there at the finish line. But hopefully that grind, that other 99% we don't see, hopefully we're feeling God's pleasure when we run that. It's so enjoyable that it doesn't even feel like work. And that's what I'm hoping for,
Right. So that's, if we go back to that same metaphor, marathon, it's the 17-mile second wind.
That's right.
Right? So what happens in the body, the endorphins kick in, the pain lessens, and the vision gets closer, right? The finish line gets closer. As an entrepreneur, have you had those same kind of moments? And how did you get over the hump?
Yeah. In the beginning, no. In the beginning, totally demoralized. Felt like, I was the only one. And you have to remember contextually, right? Like, again, very much an OG here in Southern California. Most of my best friends, if they were getting into venture entrepreneurship, they would go to the Bay Area, right? And this is what I love about you guys. You guys are doing it. You're doing it here at home,
In the
right?
backyard.
And we're putting a stake in the ground. And what's funny is, that support system, that ecosystem didn't always exist here in Southern California, which is why I'm so proud of you two. Shout out to both of you for doing it here.
And Tony. Tony's not here.
And Tony. Yes, Tony. Love you, Tony. So with that in mind, it was hard in the beginning because, everyone said you got to do it up north. If you're going to do anything in this startup space, you better go up north. And so where was the things? And for most of the entrepreneurs I meet, especially first-time entrepreneurs, right? To your point, Mike, it's not a lack of grit. It's not a lack of determination. It's basically the hardest question to answer is, how do you know what you don't know? That is the hardest thing. And so for me, like not having anyone to really ask these questions to during those early years, those failures, right, actually had to turn into learnings, right, for me. But that's when that, exercising of the muscle, as you're kind of calling it, those things didn't feel as, they were failures anymore. They just went, oh, this is one way not to do it. And somehow retraining yourself to enjoy that. I don't know if it's like a masochist or something, but bring it on. Like these learnings, these, fail fast, fail cheap, if you will. But the hardest thing again was not having that ecosystem, here in the beginning. So,
Right. It is important to be surrounded by those that have gone before.
Exactly.
Those have been successful that you can model off of. Mm-hmm. But at the same time, what we do, startups, being a true entrepreneur, is internal. It's in you. Mm-hmm. It's that driving force. So could you tell us about what your internal driving force is?
Yeah, I think funny question. I think the best way to even answer it today, I have a 16-year-old son, and I remember as he started learning about venture and, learning about what I do, he's like, Dad, are you actually a good entrepreneur, a good founder, even an investor, Dad? I was like, son, why do you ask that? It's a funny question. He goes, well, if you're really that good, wouldn't you be retired by now? Right? And I was, wow, that's a interesting question. So I asked him, what do you think success or retirement is?
Right.
His direct response was, well, I thought you and Mom would be probably on the beach, sipping a pina colada, right? But the absence of work, not working. I was like, oh, that's interesting. That used to be my definition too. But as I, found, I kind of reframed that definition to mean, simply just doing more of what you love, right? Less of what you hate, right? With people you like. And that's it, right? And hopefully on your own terms, right? And so what was interesting is, you could, be on the beach, relaxing and doing nothing. And, but that gets old. I mean, innately to your point, Mike,
yes.
There's something in you that still wants to build, that wants to create. And that is just, let's wash and rinse and repeat. And when you're doing that, again, if you can find this innately in yourself, it doesn't feel like work. And so for me, like by that definition, anyone could be retired, air quotes, right? Tomorrow, right? If that were, kind of your mindset.
No, you're right. I mean, I had a rule: you never mention the R word in my presence. Because people
No, I'm just kidding.
kept telling me for 20 years, when are you going to go retire?
Yeah.
And I didn't want to hear it.
Yeah.
I was having a ball. Had built my company to a national company, sold it, and then started Fast Start as an incubator. And so I got to play with 100 startups and 100
Let's
concepts.
get Mike in the seat. Let's turn this around. I want to interview Mike.
It was play.
He has a podcast coming out. So I interviewed him.
Excellent.
Yeah.
So the deal is, I'm as busy as I ever was.
Yeah.
The structure has changed. Like you said, you pick what you want to be involved with, not what you have to be involved with. It's a big difference.
Think about this, and I know Elena has a question, but think about this. We're right now in the studio. It's Thursday morning / afternoon, and we get to come in here and talk about startups.
Yeah.
Like to each one of you, I'm assuming you guys love this so much, it doesn't even feel like work.
No.
Right?
No.
And I get the privilege of sitting down, talking to you, telling my story. I want to hear about your stories. this again is not work. This is to me part of that. I'd be doing this, even if, I had to or didn't have to. I mean, I am. So,
The saying, my mentor always said, if you're not growing, you're dying. That's exactly what you guys are saying. But I want to bring this back to you, Josh, because your story is unique. You run Gumshoe Ventures right now, your family office, but you didn't start up as a founder.
No.
Tell us your journey.
Far from it. Yes.
Far from it. Tell us your journey.
So, very conservative, very conservative. My dad passed away very, very young when I was in 6th grade. So raised by a single mother. She took multiple jobs. She was a nurse here, just down south here in Long Beach. And I mean, she wanted to get everything right, education wise. So I was born, raised in Southern California, went to school, UCLA, then grad school at USC. Didn't know any better, graduated early. If I could go back in time, I'd actually take time, and just enjoy college more. But did all that, got the corporate job, got the corner office, W-2, right? Benefits, 401k, you name it. Any debt was bad debt. Had an argument with my mom the other day, wanted to buy her car, and she's like, 0% interest? No thanks. I'm like, no, we'll take it, but every debt was bad debt. And so very conservative background. And so went the corporate route for about 12 and a half years. I was at Ernst & Young. Loved my time there. The people were amazing. The network was even more incredible, right? And then the bridge to startups, the bridge to entrepreneurship was really through friends. So I had friends from high school, college, study abroad, you name it. And so all of them, I think there was good group of us, 9 of us. I was the only one that went into accounting. That's what they, told me to do, right? It's
who's
secure. They was UCLA. They was my mom, my aunties, my family. And they're
right.
Pay off your student debt if you can, graduate early if you can, save some money from the tuition, just the straight and narrow, right? And it made sense. I totally thought that would be the path. And I think I accomplished, what I set out to accomplish in that space, to the point where I think I probably stayed a lot longer than I probably should have. I was super excited. We had things at Ernst & Young Entrepreneur of the Year. And I got to interview these entrepreneurs, these CEOs. And in one hand, I was like, you guys are crazy. Why would you do this? Why would you give up, these securities, these assurances to do something that is imperfect, uncertain, it may not work. Why? But there was also this other side of me that was in total awe, right? That I wanted to be like them, And so there was this conflict happening inside of me. But again, going back to my friends, they all ended up going to investment banking. So they're like, bye, have fun in accounting. Great. And after 2 years of investment banking, iBanking, they ended up going into venture capital, as they call it, graduation. And then the funniest thing happened, none of them made it past their first year. So they all took, seed rounds from their own respective funds. And so when it came time and we didn't even have pitch decks. That's how old I am.
When you say they took seed rounds, meaning they took seed rounds for their own company that they started?
So let's say they were at, IVP, or they were at Canaan Partners or Redpoint Ventures. They're like, you know what? If it means investing in these other ideas and entrepreneurs, we have other ideas. Can we get a seed round from, X fund? And they said yes. And they came to me, again, not a pitch deck, because they didn't exist back then. It was a 70-page business plan. You guys remember business plan? That's how old it, right? So they give it to me and just, Josh, can you be our token board member? Do you want to invest? Yes and yes. And I just fell in love with the process that they were going through. You guys are crazy, but I'm here as a friend. Yes, I will. But there was this thing that happened innately. So, Mike says, innately something triggers.
Something is calling you out, yeah.
Yeah, I was doing work for the Fortune 50, I loved it, right? Biggest companies in the world. And yet my excitement when it came home, when, my wife asked me, how was your day? The first thing I would tell her was, do you know my friend is actually raising this seed round or pre-seed from friends, family, and fools? I want to invest. Can we invest? Should we invest? And when they did, it was like the greatest sense of achievement, right? And innately, again, going back to, carpe diem. And here's the irony, right? And I hope people out there, it could inspire or maybe even encourage someone. I thought in my 20s, it's like, I can always have time to go back to entrepreneurship, right? I could do it when, I have a bigger bank account, less risk. It'll be easier to start my own company. It only gets harder. No one told me that either, right? Because now, maybe you meet, the person of your dreams, you get married, you have kids, you have a mortgage, you have responsibilities. When does it get actually easier to actually start your own business? And so, one of the other things I mentioned, off camera was, being an accountant at an accounting firm. I love them to death, but I got really good at seeing risk. That was what I was paid to do, right? I could tell you, bar none, why something wouldn't work. I was really good at it.
You became an expert in that.
I became an expert at telling you why something won't work. And so that, again, is the antithesis of even entrepreneurship, where it's like, I don't need 101 reasons why it won't. I just need one about why it will work. And so the longer I wait, the harder this is going to become. And shout out to my wife, All-Star. I think that's one of the most underrated ingredients of entrepreneurship, is having a support system that actually encourages you to do this. My wife's family, actually the majority of her family, they're in full-time ministry, pastors, teachers. And so I might have been the black sheep of the family when I came in. And what do you do? Are you a youth pastor? Are you? I'm in business and I'm an accountant. And they're like, oh, so when are you gonna move into the ministry? I was like, maybe one day if it's in the cards. But she was like, well, if you're gonna do it, do it. And I think my wife is actually more in spirit an entrepreneur than I am. She's decisive. She makes really good decisions and way smarter than I am. But to her, it was not even a question. You got to do it. If you feel this calling, again, going back to Eric Little, you feel God's pleasure when you're running. If you don't even, when you're doing this and it doesn't even feel like work, it's not about the money or title anymore. You got to do it. Right. And I'm like, okay. And so with her support and encouragement, that's when I made the jump. And we started, again, we called it venture building. So we were thinking about writing some checks, thought we were calling ourselves venture capitalists, but we're like, we can't write that many zeros. But what we can give you is our time, our expertise. We'll roll up our sleeves. We'll build with you. So they ended up, coining venture builders, which is now more commonly called venture studios. Yep. And so that's how
He runs one too.
That's great. So kindred spirits. And so that's how I got into the venture and the investing in the building side.
Well, let me ask you a question, if I may.
Yeah.
So you're sitting on the fence here, right? You've got this internal love of startup entrepreneurship, the unknown. On the other hand, you're trained in formulaic approach to everything.
Yes.
As an accountant, if it doesn't fit in a formula, it doesn't fit, period. So now we go and you're going to invest in companies. So in a common vernacular, are you investing in the jockey or the horse? Your formal background would be the horse. What's the operating system? What's the market, et cetera, and all of those things that you study. On the other hand, in your heart, you're with the entrepreneur, the jockey.
Yeah.
So tell us how your view and how you balance.
Oh man, I know Mike already knows the answer. I love the framing. I love the question. So earlier on, absolutely, the jockey over the horse, right? We had this formula, even on our whiteboard. I still remember it to this day. It was like, best ideas we've ever heard, right? With mediocre execution, still bad idea, right? And yet we had some ideas, right? With the best execution could still be like the best idea. And so for us, it was all about execution. And again, being, truly an accountant, by trade, we also had another formula where we're like, hey, startups are interesting because I could be Forbes 30 under 30 and win all these accolades and Entrepreneur of the Year and Deloitte's fastest 50 growing companies. And yet, several years down the road, we hear that they couldn't raise into the next round. They had to fold. And so we're like, you know what? And so formulaically, to your point, we came up with the 4 outcomes, the 4 exits. So we said, oh, either one, you go IPO to the moon, right? SpaceX. 2, we get acquired. That's a great, outcome, potentially, right? 3rd, we like, hey, maybe it's a lifestyle business. It's like, pumping cash. It's still a business. Mad respect for those lifestyle businesses. That's great, right? Restaurants, laundromats, you name it. And then there's like this 4th outcome where we said, man, you could go bankrupt. You can literally go bankrupt if you can't raise into your next round, have a down round. And that's a real outcome. And so we also noted, we're like, hey, we're not against any founder. We're not even against ourselves, to maximizing the fiscal outcome of a startup. But our whole formula was we want to maximize the probability of each fiscal outcome. And so that became kind of our mantra where we, again, this thing called math kicked in as an accountant. We're like, hey, if we spin out a company in the studio and we actually start out with 100%, that's an interesting flip of the equation because now we get to, give back to the entrepreneur that we're working with 10, 20%. We could hire, a C-suite, for another 10, 20%, and maybe, a team at 10%. And something ultimately happened where we were building really good businesses and we started getting offers, right? And these offers were not the billion-dollar unicorns that we imagined, but they were in the ranges of like 25, 50, 100, $1 million. But this was in year 3, 4, and 5. And when we looked at the cap table, we can get into cap table management too. We were like, we're still at 60, 70%. And so again, in contrast, some of my friends had these unicorn exits, great. And, I ended up with less than maybe 0.25%, which is still great because I got liquidity and learned that I could actually, cash can make you rich, equity can make you wealthy sort of thing. But my last exit, it was, I had 96% of the company still. We did it in, 15, 18 months. And when I contrast these two spectrums, which one's better? Like, there is no right answer. That's the funny part. Like, to each their own. Some people are about raising into the next round. I want to be in front of TechCrunch, VentureBeat, Forbes 30 under 30. I mean, it's at a controversial list. But for us, we actually are focused on the acquisition. We're focused on the exits. And for us, it did evolve into a formula. Even though, again, it's all about the jockey. But we did come up with that conclusion. Hey, if we work backwards and we have a number in mind and we're going to build this, does someone actually want to acquire this? Like, don't you want to know now or today? And I get the comeback to this. I mean, Mike's probably going to tell me, well, yeah, but who would reveal their secret sauce so early? Like, we would. Yeah. We went to the potential suitors and asked them, hey, we're not the smartest people in the room. We get it. But if, I'm you and you're me, like, wouldn't you be working on this? And oftentimes it wasn't even like the true Hollywood story where you get a call from Google Ventures. Hey, we want to buy you for $1 billion. It was more like, yeah, we're going to come and crush you, Josh. Don't even bother building this, right? We're doing it. Like, do something else. We really like you. And we would go to these suitors, sometimes like 4 or 5 of them, and they would all say the same thing, right? I had some co-founders at the time and they all came out demoralized, already thinking about the pivot. For me, having these conversations so early, I came out like all excited. I was like, no, this is validation. All 5 suitors were saying they're going to, I guarantee you we're going to do it better, faster, quicker, and cheaper.
So a few weeks ago, sitting in the very same chair you're sitting in. Yes. We had another stellar entrepreneur, and he and his partners decided they were going to build something and they were going to sell it to Google or Microsoft or Yahoo. And they had their strategy right from the beginning, just like what you're talking about. And they went first to Google. Mm-hmm. And they got a $1.2 billion buyout. They were given $350 million upfront, and the rest was an earn out. And after 4 years, it pancaked. So they picked up another $100 million. So they exited with $450 million out of the 1.2. And so you'd go, oh, boo-hoo. But when you do the math,
yeah.
right? But those guys who owned almost all of it $450 million ain't a bad exit.
Ain't a
brother,
bad exit.
You know?
Can I get their number? No.
But that's what you're saying.
Yes.
You know, don't get caught up in the unicorn race. Stay in your lane. What works for you? What'll work for your life? Your partners, your partner at home, your partner at work, right? And what works for you?
Funny question. When I ask, some entrepreneurs, the question like, why are you building this? I've done a lot of teaching at schools and universities. Why do you want to do a startup? Right. And I got almost every answer in the sun. Like, I want to disrupt the industry, want to do good, want to work with really cool people. I don't want a 9 to 5. I want to, I guess, 24/7, job. And no one has ever, raised their hand and said, Mr. Joshua, like, I just want to be rich. I want to make, like, I want to be wealth. Like, no one's ever factored in money. And the funny part about your last comment about these entrepreneurs, when I get into the room and we kind of work backward, I love telling the story. I have these 4 partners who they were in event space, management. And they came to me and they're like, great, Josh, tell us what to do. Like, we're all ears. And I was like, no, that's not how it works. And they're like, what do you mean? I'm like, well, if you would entertain me, I was like, do you know what number, would be considered success to you? What would change the life of you and your family? Right. And they're like, we never thought about a number. Right. And they started giving me numbers where it's like 100 million or 50. And I'm like, no. Don't give me a ceiling here. Give me something where it's like a minimal floor. And for dramatic effect, I had them write it on a piece of paper. I had 4 of them. And they slid it to me one by one. So I wanted to keep it, kind of suspenseful. I opened the first, piece of paper. And the funniest thing was I looked at the number and I said, funny enough, I'm assuming you guys have never done a valuation, 409A, that kind of stuff. They're like, no. I go, yeah, you've already hit this number. And the funny thing, I don't even know why you're still here. If this is really, in fact, I love you guys so much. I would buy out your share, like, if you would have me. Now there were 4 Black entrepreneurs, so having the Asian guy come in probably wouldn't be a good story or narrative, right? So I was like, I want to preserve that. But let's move on. I said, okay, the other 2 came in, and their numbers were very much aligned with their projection. They had been in business for 3 years, and they were growing year over year. But I also had them write down a second prong, which was, how many more years are you willing to put into this business, right? So one of them writes down probably another 3, okay? The other one said 10. And so the air got sucked out of the room. Everyone looked at the person with 3 years and said, what do you mean? He's like, well, I want to get married. I want to buy a house. I love you guys, but I'm not a historian. I don't want to be here forever. And so I was like, oh, do I need to leave the room? It sounds like you guys haven't talked about this topic. Right. And then I was like, okay, well, table this again. And then the 4th one, right, didn't even entertain my exercise. It's like, she wrote down unicorn or bust. And then she wrote infinity sign, as long as it takes.
Yeah.
So I looked at her and I was like, you want to know the good news or the bad news? She's like, give me the good news. I said, the good news is you can usually find one person in every group that you can build a long-term business off of. And luckily that's you. She's like, what's the bad news? I go, you asked me if you guys should raise capital. You're 3 years behind in raising capital. If you're going to even come close to this trajectory, you need to raise, and you needed to have done that raise, And so the point was, if I had started that conversation with, here's what I would do, I probably would have been doing all 4 of them a disservice, right? Not knowing, again, what the objective of even starting this business is. And so that's the whole thing, I think, to your story. Like, well, what is the objective? Do I really need, 100 million? Could I not live life with 10, right? Am I hitting that number? And so that whole anecdote, I guess, of that story reminded me that, us as even mentors, investors, are we even aligned, right, in what the objective is? Am I making this investment for 10, 20 years, right, a la SpaceX? Or are we like, hey, we got an exit, let's take it. It's only been like 2 years, let's take it. The IRR would be, the internal rate of return would be amazing, right? So even that, I think, is something first-time founders don't even
So
push.
if I can unpack a couple of things by the way, that was awesome. Thank you. And I think that in itself is gold. And it's exactly what this podcast is about, how a serial entrepreneur goes about it, from the mistakes and the learning from the beginning. And you nailed it. So thank you for doing that. And thank you for sharing.
We're on a monologue. Sorry about that. But yeah.
Thank you for sharing it on TCVN's, my first overnight success. But I'd like to unpack a couple of things. One is what the driving force was. And I, like you, have interviewed hundreds, if not 1,000, startups that either wanted me to invest or wanted to come into Fast Start Studio, my incubator. And I have had those that say, I want to make money, over and over.
Oh, you have?
Yeah. Oh, I've had so many.
Love it. Okay.
And all the other kinds. But what I was looking for was someone who was driven to solve a problem, a problem that had such a big audience that the market would bear the investment.
Yeah.
So that's part of what I was looking for. And,
Sorry.
Go ahead.
Finish what you're saying, because we're going to have to go into sponsorship cutout. So.
Okay. So the second thing was, where that exit was. One person had it 3 years in mind, one 10, and one never. Mm-hmm. So there's this spectrum of life.
Yep.
And where you are in that spectrum is going to dictate, right,
Yeah.
what's important to you.
Yeah.
And for me, when I had my first big success, I had smaller successes and I've had my failures, but the big success was a cash cow and I loved it. And I was able to build a solid financial base for not me, but my kids, which is what was driving me. And after 27 years, the focus changed.
Yeah.
There was enough money. My kids were going to be okay. I had a ball doing it, but my vision of myself and where I was in the life curve changed. And I said, it's time for me to exit. And then I, positioned the company to be acquired. And then I went, wow, there's life after, right?
Yeah.
Let's do it again.
Let's do it again.
And that's the wonderful thing about entrepreneurship. You take it with you wherever you go. It is a very valid talent. Even if you go to work corporately, you're worth so much more than someone who's never had business experience or run companies, build companies.
Sure.
So yeah, that spectrum falls into it. And I think that's where your own story is influenced by your wife and your age.
Yep.
And I'm not saying you're old because I'm the old guy in the room, but it has a bearing on this.
Different seasons of life. Yeah. Absolutely.
I always think it's really important when we focus on our why. Why this is important to you, and that's what you did with your people, is really helping them dig. But before we continue, let's have a word to our sponsors, and we'll be right back.
I'd like to introduce our sponsors because without them, this podcast would not exist. First is CloneForce. CloneForce builds digital teammates that help people get everyday work done 50 times faster and around the clock. It's like having a digital teammate. So you just need to make one AI agent to help run the entire company. Next is Reed Smith. It's a globally recognized law firm helping founders navigate every stage of growth, from formation to fundraising, to scale and to exit. Finally, we have Sunstone. They support entrepreneurship, education, and inclusive innovation by partnering with universities, nonprofits, accelerators, and public and private initiatives to help opportunities for the next generation of founders. Together, these partners represent the future of entrepreneurship, combining technology, legal expertise, and community-driven opportunity to help founders build, scale, and succeed. Thank you to our sponsors.
So, you had said someone even told you that you're not investable.
Yes.
How did that feel?
Oh, and this actually is salt in the wound because it came from my best friend. Yeah. And this best friend, I'll give you some context. He is a venture capitalist, a really good one, by the way, who actually now, in hindsight, currently is one of our lead investors. But this was earlier on when I didn't understand venture yet. His words were, "You're not venture backable." right? And so I didn't know what that meant. So for me, I was like, I'll show you. What do you mean I'm not venture backable? And I just thought that meant, like it's not, big enough, or he didn't believe in me. But again, I didn't understand the rules of venture. So one of my favorite things to do with an entrepreneur as they're asking for an investment is I go, comments like that. Do you actually understand, the venture fund? Do you understand the angel investor? Do you understand? And it's usually, no, I just am asking for an investment from Mike, from Lillian, and from Joshua. I'm like, okay, well, if you're going to give up 5-10 years of your life to this startup, like, do you know the rules? And they look at me like, I'm not following. And I'm like, well, do you play a sport? Do you guys play sports? What's your favorite sport, Mike?
Golf.
Golf. It's like me and Mike, come out and, he gives me a handful of clubs and it's like, we're going to go play golf. And so as, I tee up on the first hole, I wind back, pick up the ball, and I throw it as far as I can. And Mike's like, what are you doing? I said, I thought we were trying to get into the hole. You are, but you got to use these clubs. And, I didn't know that. Right. And so same thing with venture. What's funny is, Mike is asking, about alignment and, what he looks for in an entrepreneur. What my friend was saying was, Josh, if I give you $10 million, and he had a $100 million fund.
Give us perspective. When was Josh at this point in period in your life?
No, this is like very early stage, like startup 1 and 2.
Were you still at Ernest Young?
No, I was out.
Yeah, okay.
I was out.
Okay.
And that was why, I was going to friends and say, hey, now that it's my turn, I want to take a stab at being an operator. I want to execute. I think I can do it. I was shocked to hear my best friends, who, again, are VCs by title, by occupation, at the very least would back me. And, I was relying on this for a salary, to draw from for early investment. But, the pitch deck or business plan I had put together is like, you're not venture backable. And so that's the context. And so what I didn't understand was, and this was the education part, was, $100 million fund, Josh, I give you 10 million, right? First investment out of the fund. Let's say you give me a 10X. I said, great. And he asked me this question. He's like, how much do you think I make off of this 10X? And I was like, I heard something about VCs making 20%. So I said, oh, you probably make, out of the 100 million, you probably make 20 million. He's like, no. He's like, I actually make 0. And I'm like, I don't understand. He's like, well, I have to repay the fund first, right? So if I make a $10 million investment, let's say I make 10 investments, I don't get any of it because I haven't got any money back to the fund. I have management fees, I have all these fees and overhead to pay. And yet the replenishing of the 100 million, while grateful, right? I don't get any carry, right? Carry is the part where after you pay back the fund, then there's that, allocation, like probably 20% to the GPs, limited general partners, 80% to the LPs. So he's like, if you just repay the fund, I got 0. Now, if Lillian comes and she's part of my fund and she, sells her company for $1, I'll probably get 20 cents, for her exit. But on yours, I don't make anything. And so he goes, Josh, you have to understand that if we take a shot on goal, right, and I give you this 10, right, and you don't come back with at least that amount to overcome all my other losses, and you say 9 out of 10 fail, that's, I don't get to retake that money and redeploy that into another investment. That's it. It just goes back into the fund. And so what I mean is the return is probably not big enough or fast enough for me to be venture backable. And that wasn't as insulting after I heard the explanation. And I was like, oh, okay. So now I understand the mechanics. Now I understand why. That if I, because I probably will take, a 5X if I got an offer at year 2. And he would be like, no, because all my other ones have failed, And that's not to say even to Mike's other point about alignment, we had the same VC, right? The same VC, same institution come in on one of our startups. We loved her to death. She was fantastic. Style, hands off, rolled up her sleeves when we needed her to. The perfect VC, right? And we said, hey, if we have another startup in the future, we'd love to do business with you again. We go back, do the exact same, person, and every other week, Josh, how are we doing? How is the investment? And it was like, whoa, micromanager, what happened? I don't understand. And again, another part of the rules. The first time she invested, she was a brand new fund, a 10-year fund. Take your time. Everything's looking good. Money's at 0% interest. We're good. People are exiting. We're fine, right? Second time around, this is like maybe 7 or 8 years later, we were at the end of her fund. She saw how the other companies had done. They call them vintage, and the vintage was not good, right? They had invested at very high valuations. And trust me, when I say we got an offer at, an 8 to 11x, not good enough, because it wouldn't make up what? The rest of the fund. And so she was like, I need probably a 22, 23x to break even. So we're going to have to say no to this offer. And we're like, what? And so again, like, nothing to the VC, nothing to the, these are just the rules of VC expectations, right? Versus maybe angels who are like, any return, fantastic. And so really know the rules before you start, getting investments.
So that's a great question.
Yeah.
Because you're a family office.
Yes.
You're not going by the rules of a VC, are you? Like, tell us how you operate.
Well, I don't want my startups to fail and go bankrupt. So that's the same rules. But I'll give you an example, and shout out to Elizabeth Yan, who's also one of our investors and one of my favorite VCs at Hustle Fund. But she and I debated. I remember this very distinctively on the pier at San Francisco. I said, hey, if we can exit, in advance and exit backwards, and she was like, no, that doesn't work. And again, going back to understanding the rules, for her, it may not replenish the fund. She'll have to put it back in, and then until the next fund. For me, my family office, as an angel, even when I get a return, right, even if it's, it goes back into my family office. I can redeploy that dollar tomorrow, right? So time value of money, you name it, every thing under the sun. I can then take that and then reinvest it in another founder, another one of our startups. And so my rules are very, very different. And I look at IRR more importantly, right? And then to Mike's point, I mean, life stages change, right? Like money is not the end all be all, right? In terms of that. Even this one startup, we believed in so much that we knew probably wouldn't have that fiscal maximization, that fiscal outcome, but we believed in the team. And the team actually became the product, which is the funniest thing. The people became the product. Yeah. And so we were like, if we can do right by them, if we can train them, again, how to fish, if the good that we're going to do here will be exponential, right? And so, yeah.
So when you invest in your portfolio, what do you look for?
Well, I think to Mike's point, a very good jockey, right? Where certain things like, feeling like it's not work. Again, that's one of my main criteria is like, when I'm going to bed at probably 2 a.m. in the morning, I know you're going to be up, trying to figure out this problem. Number one, right? Number two, like I have this rule with my wife. I try to get home for dinner, and have the family time. But when I'm in the office and we get one more entrepreneur coming in to pitch, and I know you've been there too, Lillian, right? Because we know some mutual founders. That temptation to stay because we enjoy this conversation so much, and it's worth maybe even getting into the doghouse at home because this is so fun and enjoyable. That is a very, very powerful trait where I can see us, working together and just like, again, not making it feel like work for me either. Right. And that enjoy coachability and me learning from them as well. I think it's amazing.
So what?
I'm sorry.
Hey, go for it.
Sticking to the family office for a moment, and then we'll go with Lillian's question. Because it's a family office and not a fund, you're not taking other people's money, so you don't have to have a Series 6 or 7. It's a whole different regulatory field. Is that one of the reasons why you chose that format?
It's twofold. One, I do offer, in addition to the family office, a syndicate. So we've had people in our... They're separate, though. Yeah. They are completely separate. And the reason why is even team members who have been now along the ride for these exits, some of them want to stay operationally because they love it. doesn't feel like work. They love the people. And then two, they're like, hey, but we want to learn how to invest too. But managing other people's money, right? It's very challenging because, again, objective wise, right? I may want to make one of those decisions where some funds have this thing called a 10% Dreamers Fund, where it has nothing to do with their thesis, right? And for me, that maybe happens more than 10%. So I feel responsible for, that. But I do offer that opportunity. Hey, my family office, my fund is investing in this. And I do allow others to come alongside and maybe co-invest or maybe come alongside as a sidecar to that. And for me, I get the best of both worlds.
Yeah.
I get to teach,
but that's
mentor.
totally different.
But I am the investment kitty, right?
And exactly. I mean, you are getting the best of both worlds because you can act as a VC and all that entails with being involved with building a network of like-minded investors.
Correct.
And at the same time, the autonomous approach of having a family office and doing what you believe is right with nobody else telling you what to do and no regulatory, body sitting on your shoulders. I think that's wonderful from my perspective.
Yeah, I think there's also this community effect.
Yeah.
Right. We come alongside and we're not, just us or anything. Like we have other startups where we've now, ironically, don't need to raise. Either we have a model that's profitable, or two, from our previous exits, we now ironically have money that we can now invest in. But there is something to be said about having community. And so, going to, Muck or Operate, Fika, and coming alongside and saying, hey, we're going to, do this. Do we want to invest together? It does build a camaraderie, right? In some forms, there was a couple of investments we made together in our startups where we didn't have to actually exercise, them in our exit. We actually had a payback clause where we said if we don't use the money for growth, then we exit within X amount of time before, this note is due. We could pay it back.
Boy, that's unique.
Yeah, and that's even a funnier story if we want to get into that. But when we had that payback clause, and we got an offer, we got the congratulations first. And then the second question was, are you going to exercise this? Right? And the answer was always like, prayerfully, yes. We want to honor this arrangement and agreement. Again, not because of the money, but because, in the future, there might be a founder, there might be a startup that I'm going to call upon and your expertise or your help. And hopefully you put that house money back into this community, right? And again, hopefully in SoCal, I go back to, we cheer for the Lakers, Dodgers. Like, why do we, versus the Giants or the Warriors, like SoCal pride. And so again, allowing our community here in SoCal to benefit from, our building, our exits, or even our knowledge base and ecosystem is important.
And that's what we're all about at TC.
I love it. Yeah.
Not just us. Josh, he also has the exit community, which I have went, and it's amazing. It's also a community of founders and investors come together, and we've been talking about collaborating on events. I love going to his events. I got so much out of it myself as well. So I would say we're all community builders, and that's what we love being here.
Yeah.
So what I wanted to get to you earlier was, if I were to pitch to you, or anyone that is listening, they want to pitch to you, what are you looking for? We had George Carpenter, the president of TCA here. He's looking for AI. We had OG Arabian Prince for his Innovate Fund. He's looking for the people.
Yep.
Right? So what's going to catch your attention and it's going to give you the spark?
Okay. So all good answers. AI is awesome. For me, it's, again, our community is actually called Exit Hours.
Exit hours.
It used to be called office hours, and my son changed the name and said, Dad, no one wants to go to office hours. Sounds too academic. So for me, one of my strengths is, look, I think there's 3 stages of a startup. It's starting it, it's executing it, and then it's exiting it. And so, again, having been so attuned to the exit and understanding the exits and structuring and engineering the exits, what I'm looking for is a founder who is coachable. The number one, that's probably one of the biggest traits. And then 2, just understanding that to them it's something where, I'll give you an example. Like if I gave you guys 6 months to research collecting comic books, right? There's still no way after 6 months, even though you're super smart and intelligent, there's still no way I think you're going to catch up to my knowledge of comic books, right? It's just something I do I've done since I was a kid. On my free time and every waking minute and every hour, I'm studying like comic books and what's going on and with collectability. And so for me, I'm trying to find someone who is an SME, a subject matter expert in what, and there's different terms for it. You might say they're passionate about it, but they just know. They just know that space inside and out. And I don't need, again, for them to be like the smartest person in the room or the end all be all, but they know when they're right and they know when they're like wrong or don't know the answer. And so they're very keen to be like, you know what? I don't know, but here's my thought, and walking me through their processes, because I'm not going to correct them, right? Like they're the SME, but showing me how they think through it. And in every waking minute and hour, they're thinking about this, right? Like I would be about comics. That is something that I think I'm agnostic to, like doesn't matter. It could be in consumer products, CPG. It could be in SaaS or fintech. My level of expertise, my network can help in these particular areas stronger than others. My only one rule, and I'm sorry for the restaurateurs out there, like I cannot invest in another hospitality and restaurants. I had a stint from 2007 to 2017 in the restaurant business. And that was the hardest thing I've ever done out of my business career. Like I probably could not do another restaurant. I fell in love with restaurant tech, but I don't think I could do another restaurant. So, yeah.
So if anyone is watching, if they want to get in touch with you, what's the best way for them to get in touch with you?
Yeah, we can do LinkedIn. There's a lot of Joshua Lees out there. So often imitated, never duplicated. But I have a middle initial. That's a letter Y. So Joshua Y Lee. And then probably first thing that'll pop up will be that, or at Exit Hours, Gumshoe Ventures. Either one of those will probably.
I'll make sure all of that is in the show notes. So if you guys want to talk to him, you want to pitch him, you want to go to check out Exit Hours.
Yeah, come by.
With
we're in Southern California.
We're going to do an annual event together. So you guys want to mark your date for that. Come into our community. And before we wrap up, is there anything you want to say to our audience? Our audience are founders, entrepreneurs looking to grow.
Yeah. I don't know if anyone's ever done this yet. I'm an avid listener on the show. And I know, ironically, we're in the Christian podcast. Can I actually pray over you guys? And, I know this is going to go out, to many listeners out there, maybe today, maybe some other time. But I also am on this huge thing where God's teaching me, like, nothing is by chance. We might think it is, but in crazy circumstances, even Lillian and I meeting, it was hilarious because my son is in this youth group and one of the youth workers was running late one day and he came rushing in like, and, Jonathan, shout out to Jonathan and in soft school. He comes in and he's like, oh, I'm so sorry I'm late, but I was part of this, pitch competition and I didn't even know, if I should do it or not. And I did it. And I did well, and then I got into like the next round and a round after that, and then there was this really awesome person who was a judge. She was, I think she'd be a really good mentor, and she asked me to stay, and I stayed. And then she was asking me like, well, how much time do you need to actually get to get to your church? And as they were talking, they realized, we go to the same church. So he came to me and he was like, hey, do you know Lillian? I go, no, I'd love to meet her. Like, where is she? She's like, she goes to our church. And I'm like, what are the chances? And I'll say that saying a lot. What are the chances? And I've stopped saying that because I think there is a purpose and reason for everything. Even those who are listening to this show right now, you are probably meant to listen to this show. Like, there is no doubt in my mind, things happen for a particular reason. Whether or not we're cognizant of it or not is another story. So if you wouldn't mind, I'd love to pray.
Yeah. I just want to kind of get listeners. An amen to that. Yeah.
And just a blessing on what you and Mike are doing, because I think you guys are blazing a trail. And I just, wish favor upon you guys wherever you guys go.
Thank you.
That doors would be open, right? Amazing things are going to happen because you guys are putting yourself out there. But I also think, there could be a lot of what we call, spiritual attacks too. So I want to protect you guys.
Yes.
Would that be okay?
Let's do it.
All right. Lord, thank you for this time. We can just gather in this awesome meeting place. And we just thank you for this time we can come to you knowing that in everything we do, Lord, it's from you. And for those who are listening that just need that encouragement, who are feeling down, who may not know what their true calling is, I pray for them. I pray that you would just assure them that their blessing, their reckoning, Lord, is just around the corner. So I pray for encouragement. They say as iron sharpens iron, that they would just feel encouraged and that they would be blessed, Lord. And I pray for Lillian and Mike
And Tony.
just blessings upon blessing on what they're doing. And even for the people that will be coming into this seat, that, Lord, the things that are being shared and that are being said, that need to be said, will be said. And so we know without you, none of this is possible. So we just want to give you thanks with hearts of gratitude. And in your name we pray. Amen.
Amen.
So thank you for letting me do that.
Thank you.
I appreciate that. So thank you guys for having me.
So guys, today is awesome because we ended up with a prayer for everyone. And if you find value in this podcast, you know someone is going to benefit from everything we learned from Josh and also Michael today. Please go ahead and invite them to our show and subscribe to our channel because we have more live events coming up. We are doing collaborations, Exit Hour and TCVN, and we're going to do an amazing year-end event that we want to invite you guys all. So until next, we'll see you guys in the next episode.